I want to show you how you can truly accelerate your wealth building with what I like to call the Headroom Method. Almost every single person that I've helped grow their wealth over the last 15 years had one massive problem holding them back, putting the metaphorical brakes on their wealth building journey. So in this video, I want to show you the Headroom Method. It's something that I've used to accelerate millions of pounds worth of growth for my clients, and more importantly, help them overcome the single problem holding them all back from achieving financial security. I have also created an app that you can use completely for free to apply this to your own finances. I will be going through how to use this app in a minute, so grab yourself a copy in the link below. It's a great little tool and you can use it to follow along. But before I show you, I really need you to understand the big issue that I almost guarantee is holding you back right now. And hopefully it will make you look at money very, very differently. So I was recently at this dinner party a few weeks back, right? And I'm sat next to this guy that I've known for like years, right? He's a lovely bloke. And he sat there and he's doing all the regular chit chat, asking me kind of how work is going, how's it all going? You know how these conversations go. Now, he had a few glasses of wine at this point. And after me explaining a bit about the markets have been a bit choppy, but generally things have been pretty decent, he stops me dead in my tracks and goes, but yeah, the stock market's all a scam, isn't it? It's just numbers on a screen that don't really mean anything. And look, I'm sat there, I'm trying to be polite. It's a dinner party. I'm not going to debate over the salmon, right? But honestly, it really, really, really got me thinking, because that is exactly what is holding most people back from building real wealth in this country. We're really scared of investing in the UK. It's really, really bad. I've worked with hundreds of people over the years, and I can tell you that most people that I work with are underinvested. And when they actually do invest, they're massively too cautious with their money. It's basically like driving with the handbrake on, right? And look, the data is pretty clear. We're told that there's 1.7 trillion with a T just sitting in cash savings accounts for people in the UK. And most of that, of course, is earning next to nothing. Meanwhile, in places like America, for instance, they've got nearly twice as much of their wealth in invested assets in the stock market compared to us. They get it, we don't. So here's what it's actually costing us. The average UK household is probably leaving somewhere between £50,000 and £200,000 on their table over their lifetime by just being too cautious. That is not a typo. That is real money that could have been yours, but it's been stolen by fear dressed up as being sensible, right? And the result is that most people have got their foot firmly planted on the brake pedal when it comes to building wealth, rather than pressing hard on that accelerator pedal and getting their money to work harder. Now, listen, I get it, right? I get why people are like this. I'm not having a go. There's a real genuine psychology behind it. Losses, on average, tend to feel 2 to 3 times more painful than gains feel good, if that makes sense. That's just how we're all wired, right? That's just how we are. You lose a tenner, that hurts. You find a tenner on the street, that's nice, but it doesn't feel as good as losing felt bad. And the media, don't even get me started with the media. They train us, they literally train us to fear volatility. Every time the market drops by 2%, there is headlines everywhere. Market crash, investors panic. But when it quietly goes up 15% a year, crickets. You don't hear anything about that in the news, right? So people tend to apply short-term thinking to long-term money. They'll check their pension balance every single week like it's their current account. It's not. You don't need that money for decades, but you're stressing about it like you kind of need it tomorrow. It's really, really strange. And quick one on this, if you want more practical and useful tips and hints, things like that, I send out a weekly email where I share all of my strategies that I've learned over the last 15 years. No fluff, just what works. Links in the description, maybe see you there. So the question is, what is the answer to this then? Well, in short, you might have already guessed it, the way to accelerate your wealth growth is to potentially look to start moving from cash deposits into investments. And in particular, adding some of that exposure to the stock market. You see, the stock market is the single greatest wealth building tool that we have. It's the most reliable way of building long-term growth. But of course, that comes with a trade-off, right? That is the volatility, the ups and downs that your money goes through. The way I kind of see all of this stuff, when your investments go up and down, that is the price that you pay for growth. The ups and downs, they're not real risk necessarily. They're just part of the deal. They're part of the game. If you want your money to actually grow and accelerate your wealth, you've got to be okay with watching it bounce around a little bit in the short term. But most people that I see and speak to, they just cannot stomach it. So they stay safe. They stay in cash. They think they're being sensible. So after that dinner party, I'm driving home and I'm reflecting on the conversation and this whole thing because it drives me absolutely crazy. And I'm thinking about all of the conversations I've had with clients over the year, because here's the problem. I can sit and say to you or to anyone, you should invest your money because it's going to grow more, until I'm blue in the face. I can bang that in front of you and say that to you. But here's the thing. People just don't get it. People just don't care. They don't understand the upside that they're missing out on because it feels scary and foreign. So that is why I sat down and created something that I could actually show people. Something that's tailored to understanding their goals, their situation, and their actual capacity for risk, their upside, their headroom that they've got to press that accelerator pedal. Not just generic, you need to invest your money advice. I call it the Headroom Method. And here's what it does. It figures out how much investment risk, or any risk in general, you can afford to take based on when you need the money, how flexible your goals are, and what actually breaks if the market goes down and you experience losses on your money. Essentially, like I said, how much headroom you have for acceleration, increasing risk. So I've used this recently with quite a lot of clients, most of whom were scared to move from cash into investments. We're not necessarily talking about the stock market here, of course. We're talking about any form of invested asset or capital at risk asset, or who wanted to take a little bit more risk but weren't sure what they could afford to get into. Now, this is important to note. This isn't about being reckless. It's about using the full runway that you actually have, the scope and capacity that you actually have. Most people that I speak to are only using about 20% of the headroom that they've got. They've got way more space and capacity than they think. And the formula is dead simple. Time plus flexibility divided by fragility. Now, stay with me here. I'm going to break down each one of these three pillars so you can start using this in your life today. And this is the key. You apply the Headroom Method to every individual goal that you have, not just across your financial life generally, to every single objective or pots that you might have. So all your different places that you're saving for, your goals, whatever that might well be, this method applies to each individual one, not as a broad thing across your entire life. So that is important to understand before we go into this. So let's take a look at the first component, time. Now, let me show you this. I think a story that just sort of completely and perfectly captures this, right? So, March 2020, global pandemic kicks off. You will probably remember it very, very well. Basically, during that time, my job changed from an investment manager and a financial advisor to basically a counselor, right? I'm on the phone every single day trying to just calm people down, make sure everything's okay, just because the markets are dropping like an absolute stone. They dropped by I think 30% in a couple of weeks at that point. And look, people were naturally scared. And I'll be honest, even though I knew all the facts and the market data and the corrections and things like that, it did feel very different at the time. And I did feel a bit scared. But anyway, so I made a commitment that I would ring every single one of my clients just to touch base, just to explain them what was happening and try to reassure them. And I rang up this one guy. He's a lovely guy, and no offense to him, and I think he'd probably say this to himself, but he had a very, let's say, simple way of viewing the world. And look, I'm sat there and I'm explaining to him that his investments are down about 25% at the time. And his response, he just calmly goes, and I'm like, sorry, like, what do you mean? He's like, look, this money's in my pension, isn't it? And I'm like, yeah, it is in your pension. And he goes, well, you've told me that I've got 20 years before I even can touch it, didn't you? I was like, well, yeah. And he goes, you showed me a chart that said there was never a 20-year period where money went down in a diversified portfolio kind of thing. So why do I care about this? And honestly, see, when I first started working with him, I showed him that chart that illustrated that over any 20-year rolling period, a diversified portfolio had never lost money. Never. And because he viewed the world so simply and didn't overthink these things, he just had that in his head. And that is exactly the right way to look at all of these things. And that is time. That is the power of time right there. It's the single biggest amplifier of headroom that you have got. And here's how to think about it, right? If you need that money for 3 years, well, within 3 years or less, you've basically got no headroom, okay? Keep it in cash in regards to this part of the equation. 3 to 5 years, maybe you've got a bit of low headroom there. Maybe a tiny little bit of investing, but very, very cautious. 5 to 10 years, you've got medium headroom. Now, maybe we can start to look at something. 10 to 20 years, high headroom. This is where it starts getting a bit more interesting. 20 years plus, very high headroom on the time factor. Now you can afford proper growth. And here's the line that changed everything for me. Every additional year you don't need the money reduces risk. It doesn't increase it. Time turns volatility from danger into background noise. Think about it like this, right? If you're 30 and you're saving for retirement at, say, 65, that's 35 years. If there's a 40% market crash in year 5, completely irrelevant. It will recover. It always has. But people with 35-year time horizons are making decisions like they need the money next Tuesday, and that is a problem. So that is pillar 1, time. Now, the second pillar amplifies time even further. It's what separates people who can ride out market crashes from people who panic and sell. It's called good old flexibility. Now, think about flexibility a little bit like the difference between a London black cab driver and an Uber driver, right? And they're trying to get you across London, let's say, right? The Uber driver, they're locked into wherever their sat nav tells them. The app says take the A40, and then they get to the A40 and the road's closed. Well, they don't know what they're doing, do they? They've got to wait for the app to reschedule or recalculate the route. They're just following a standard route with no flexibility. But a black cab driver, they know all the routes, right? They know 17 different ways to get you from Paddington to Liverpool Street. Road closed on Marylebone, no problem. They cut through the back streets. They have already understood and rerouted to King's Cross before you even notice it. Same destination, just loads more options and flexibility. And that is what a flexible financial goal looks like. When markets throw up roadblocks, you've got alternative routes. You can delay things for a year. You can contribute a bit more. You can maybe adjust the target slightly. But a rigid goal, that's like following a GPS, right? There's one route, one timeline, and if anything blocks it, you are stuck. So here's the question then. How rigid is your financial goal? So you need to ask yourself 3 things. 1, can I delay this goal if markets are down when I need that money? 2, can I contribute more if I need to? And 3, can I change the goal slightly without feeling like I have failed? If you can genuinely answer yes to all 3, well, that is a really, really flexible goal, and a flexible goal can afford some volatility. If you answered no to some or all, that's rigid, and you cannot afford any volatility. Neither is right or wrong, it's just factual. And here's what, excuse my French, pisses me off about this. I see so many people treating their 30-year pension money like it's a house deposit that they need for next month. The same rigid thinking across everything. It's crazy. Your pension has got decades to recover from a bad year. Your house deposit hasn't. Most people don't separate them out. They just view them broadly as kind of like the same pot of money. So again, example, retirement, super flexible. You can work one more year. You can adjust your spending. You can adapt. First home deposit in 2 years, 0 flexibility. You will need that when you need that. End of story. But even if you've got time and flexibility sorted, there is one more critical question you need to answer. And honestly, this is what separates people from actually use their headroom to accelerate their wealth from people who kid themselves they're being rational when really they're just being scared. It is called fragility. Fragility isn't about how you feel. It's about what physically and actually and materially breaks in accordance to your financial goals. So ask yourself this, with whatever pot of money it is that you're looking at. If the money dropped in value by 40% tomorrow, what really goes wrong? What breaks? Here's the 3 possible answers, okay? So really ask yourself this question. 1, it would absolutely destroy you, right? Your complete life breaks. You could lose your home, you can't eat, whatever it is, you're in serious trouble. If that's you, under flexibility, under fragility, you've got no headroom at all. Number 2, your plan breaks, essentially, but your goal gets pushed back by a lot. Maybe you can't retire when you want to, or maybe you have to wait a little bit longer for that big purchase. There's some headroom in that, some flexibility, but not too much. Number 3, nothing breaks at all. You don't have to sell. You can just stay invested and wait for it to recover. That would give you high headroom within fragility. And here's the powerful bit. If you don't have to sell, the loss isn't real. It's temporary. Those ups and downs only become real, only become an actual loss when you sell. Think about it this way, right? A 40% drop in your pension when you're 32, that's not necessarily damage, that's discount. That's a chance to buy more at cheaper prices. You get the point, right? People mix up a bruised ego with a bruised plan and life. They see their pension go down by 40% and they panic, but nothing's actually broken. They've just seen a scary number. So that is fragility. Okay, so here is the fun part. How you actually figure out the headroom that you have for your specific goal. So what we're going to do is work through that app that I've created. Hopefully you've already downloaded it in the link below. It's a great little tool that will tell you your headroom score for various objectives you have. So again, what I want you to do, go down to the link below, get yourself a copy, and so that we can do this essentially together. Now, what I want you to do is really think about this. I want you to think of one specific pot of money right now that you have. Could be your pension, could be an ISA, could be your savings, could be a little earmarked pot on Monzo, whatever it is. Pick a fund that you've got in your head for a specific objective that you might have, and we're going to work through, and this is how we're going to figure out your actual headroom. What we'll do is we'll work through 3 quick examples to show you how this works so that you can start to use your own objectives over the top of this. So let's say we have 3 pots of money. Doesn't really matter what they are for now, but let's just say the first one is like a big family holiday in 2 years' time. The second one is saving up for a dream house purchase in like 10 years' time. And lastly, let's say that you're saving for retirement. So in your pension or something like that. So let's work through these together so you can get the idea and work through it yourself. So let's jump over to the app now. Okay, so we are in the Headroom Method app. So let's go through this so you just get a little bit of an understanding as to how it works and how this correlates to your objective. First and foremost, what you'll notice is it's got light and dark mode. So whatever your preference is for that, go for it. I particularly like light mode on this one for some reason, but anyway. So you'll see here, it's basically an assessment that you go through, really simple, really easy, and it works on that time, flexibility, and fragility equation. So let's start. Again, we mentioned the very first one that we're going to use is you've got a big family holiday in 2 years' time that you're saving money for, or there's a pot of money allocated for that already. So when do we need the money? Well, look, yeah, within 3 years, right? So there we go. Flexibility is up next. How flexible is this goal? Well, look, I can't delay the goal because, you know, we need that as booked in. I can't really add more, really, if needed. I've already got that money there. Don't want to commit anything more to it. And I can't change the goal at all. So I'm going to not click any of those, obviously. Fragility, yeah, if that's gone, if 40% of that's gone, I might not be able to go on holiday. The family are going to be upset. So that would be a major catastrophe. So on this case, in this scenario, of course, you've got a 0 out of 9, no headroom. So for this, it gives you an indication of what sort of potential allocation to the stock market you might be able to take. And in this case, absolutely do not go anywhere near investing your money for this particular goal. Okay, so it gives you a little bit of an overview as to what you should be doing potentially. Again, not financial advice, just a tool for you to use. So let's start with the second one, dream house in 10 years. So let's say here we need the money in 5 to 10 years. Okay, so this is saving for your dream house. No, I would say, yeah, I can delay the goal slightly. It's not like I need it exactly on the 1st of January in 10 years time. I can be adaptive. Yeah, I can add some more money in potentially. You know, I can add some more money in. And yeah, look, I can change the goal. If the dream house is, you know, 50 grand less than the other one, doesn't really matter. So let's say yes to all 3 of those. Significant loss, I'd say it only delays the goal, right? Because if I have to save for a few years longer because of the market crash, I can do that, right? There's no set period of time. So let's see what it says. Now, in this case, it's giving you way more headroom to be able to play with that. So what that's basically saying is if you've got an account or a pot that you're saving for your dream home in X amount of years time, and this is the responses that you've given, you could look to sort of spice up or accelerate that savings fund a little bit more by investing it in something that has the equivalent risk of around 60% in stocks. Now, don't worry, I'll go through an actual practical application of how you can do that in a minute, but it gives you an indication of, yeah, you've got some headroom here. You're in a solid middle ground. You can afford some market ups and downs, but you don't want to go too crazy. So that's a really, really good example. Now, third one, let's look for retirement, right? So this is 20 years plus. I can delay the goal. I can add more money if needed, and I can change the goal. I can retire earlier, later, on less money, whatever it might well be. I would say either only delays or changes nothing. really. I wouldn't ever be forced to sell my stocks. I'm going to go change is nothing if we have some losses. So here is a great example where if your pension is invested more cautiously or in a very, very low risk fund, you have huge headroom to really press that accelerator button by increasing your exposure to the stock market, which of course is where all the growth comes from. So again, here, these are just examples that give you a really, really good kind of overview as to how to use this app and try and do it for yourself. Now, I know what you're thinking. All of that is great, right? But what do I actually do once I've got that number? Now, this is where it starts to get a bit more practical. So once you've got that for your specific objective, your score, and it said it on the output. So again, when you work through it, you'll see it, but it kind of directly tells you how much risk you should take with your money. But let me break this down for you. So if you're a complete beginner, now I'm a huge fan of the Vanguard Life Strategy Fund range, right? I don't have time to go into the details of what that is in this video, but again, there's loads of stuff out there about Vanguard Life Strategy funds. I really like them because they're a really consistent range from a really consistent provider that have been around for donkey's years. Vanguard are, the investment provider. But what it is a really good method to show you how you can link up the score and the stock allocation to a type of investment fund. Now, again, your choice, not mine. This is not investment advice. All I'm saying is that you can correlate this to these types of things. Again, Vanguard Life Strategy range has basically all of the risk spectrum. So you can see there the percentages correlate to the percentage of stock market exposure, essentially. They go from low risk, which has less ups and downs that you can see there under E, all the way up to high risk, A, which has way bigger spread on the volatility. Anyway, this is just a great point to show because you can literally just take guidance from the Headroom Method and translate it to the relevant Vanguard fund because they're literally called 20, 40, 60, 80, 100%, whatever that is. So let's say in this case, for example, again, let's say you scored 0 to 2, you've got no headroom, right? Do not invest this money. It's just saying, be cautious. I'm saying, don't invest that at all. Just put it in cash, leave it in savings, and you know where it would be essentially safe. So again, these are things like emergency funds, house deposits, and anything coming up in the near term. If you scored in that sort of 3 to 4 window, you can start looking to invest here, but try to be really, really cautious. This money's got some time and some wiggle room, but not a lot. So again, a little bit of equity exposure, something like the Vanguard Life Strategy, 40% equity. Again, it's 40% stocks, 60% bonds. Lower volatility, suitable for goals kind of in that 3 to 7 year window with limited flexibility. If you're going up the scale a little bit more, maybe a 5 to 6, that's a medium headroom. This is where you start getting into balanced territories. You've got enough time and flexibility to handle some of the bumps, but losses would still sting a little bit. So again, here you might go with the Vanguard Life Strategy, 60% equity, 60% stocks, 40% bonds or other. This is the classic balanced portfolio, by the way. Often money will sit here really neatly for that 5 to 10 to 15 year window, essentially. Now, watch what happens here when you move from here. This is where the acceleration really starts kicking in. Most people stop at this level thinking they're being smart, but let's see what they're actually missing. So if you score, say, for example, 7 to 8, you have huge headroom, lots higher headroom. Now we are cooking. This money has got time, flexibility, and resilience. You should be growth focused here. So if you've got any money that has this amount of capacity, you should be looking to get much higher equity exposure. Vanguard Life Strategy 80 is a great example. 80% stocks, 20% bonds. You're going to see a little bit higher volatility, sure, and you can see it from the ups and downs of the chart there. But this is appropriate for goals that are over the longer period of time, where you have flexibility and other bits that you can play with. And listen, if you've scored 7 to 8, but you're currently invested or in cash, levels 5, 6 below, you're artificially capping your growth. You've got your foot on the brake. Over 20 years, that could easily easily be the difference between like 200,000 and 350,000. Same contributions, way different outcomes. You're leaving potentially hundreds of thousands of pounds on the table because you're being sensible. Now, that is when you start moving that foot onto the accelerator. So if you scored maximum headroom, 9 out of 9, then you have got every advantage and every maximum headroom if you're moving from a pot that you've designated that's currently cash into this sort of thing. It's got maximum flexibility. So here you might consider Vanguard Life Strategy 100. That is 100% stocks. Remember I said the stock market is the single biggest growth weapon we have. Maximum growth potential, designed for that sort of long-term time horizon. Pensions are great for this sort of thing. Huge exposure to the stock market. Now, here's what's critical. This isn't about being reckless, okay? This is rational, to be honest with you. If you're 25 and this is your pension money, volatility in the short term is completely irrelevant. You've got 40 years. Who cares if the money drops next year? It will recover 10 times before you need it. The key here is to understand that your money has jobs. And the job determines the risk that you can take. Not your emotions, not your fear, not what your mate down the pub reckons about the stock market being a scam, or that bloke that I was sat next to at the dinner table. This is how you accelerate wealth. And you need to stop treating all of your money all the same. You figure out how much headroom each pot actually has and you use it. Most people are driving around with the handbrake on across all of their money. But actually, some of that money, the long-term stuff, should have the absolute foot on the floor of the accelerator. That's the difference between getting financial security in your 50s or your 70s. Same journey, completely different speed. But here's the thing. Everything I just showed you about the headroom method fails without one critical piece. And honestly, this is the bit that catches kind of everybody out, I would say. It's the actual mindset about money. And if you get this wrong, which most people do, none of these headroom calculations matter because you'll never stick with it. Which is why I really think you should watch this video here next, because I have seen perfectly good financial plans be destroyed. So give it a click, give it a watch, because I'm going to go through why 99% of people will never build wealth, no matter how good their strategy is. So give it a click and I'll see you there.